What's up, y'all? I am Tim Bratz. I have bought and sold over $500 million of commercial real estate and residential real estate. Currently own a little over 3,000 rentals, and I want to share with you the rules of the road to buying real estate in any market. So the Fed just met last week and decided not to increase interest rates and not to decrease interest rates. So right now, the Fed funds rate is still currently at 5.25%. And inflation hasn't dropped enough for them to feel good about reducing the interest rates. And at the same time, they want to kind of maintain the status quo. They don't want to increase interest rates and rock the boat for the economy at all, especially in an election year. All right, so here's the key to understand, is you can do deals regardless of the market. You don't need to time the market. You don't need to be some sort of a Nostradamus and understand what's coming and what's going and the cosmos and how things are going to shake out. Like that's completely irrelevant. The key is to understand the framework and the components to do a good deal regardless of the market, regardless of the economy. So I'm going to give you my 5 keys to buying in any single market. So the first rule is buy at a discount or on terms. What does that mean? That means if you buy at a low enough basis, right, there's a lot of things that are fixed costs when you're doing a real estate deal. For instance, the construction. Construction is not a variable expense. You can't scale back the construction and the finishes and all. Like, that's a fixed number. And it's a big mistake for you to try to play around with the construction and the renovation expense when that is what's necessary in order to get the rents, in order to get predictable maintenance schedules, in order to get predictable insurance expense and all those kinds of things. Don't play around with the construction expense. You know, like it's very predictable of what the rents are going to be. It's very predictable of what the expenses are going to be. All those kinds of things are kind of like fixed when you're putting the equation together and underwriting a deal. You know what the only variable is what you're buying the property for, right? That is the biggest variable in the equation. The other variable is what are the terms that you're using when you're buying it, right? Are you getting seller financing? What's your cost of capital? The kind of length of time frame that you have on your money. All those things are kind of variable expenses that you can negotiate and work around and massage those numbers in order to make the deal make sense for you. If you can't make those deals make sense based on buying at a discount or buying based on terms, then you're making a bad mistake playing around with some of these other components of a real estate deal that don't really matter. So make sure you're buying at a low enough price point where you can create the appreciation and create a little bit of a spread because of the price point that you're buying it at. Or if you're paying more of a retail price, just make sure you have terms, right? Make sure you have a low cost of capital, make sure it's a fixed rate cost of capital, make sure it's a longer term so that way your back's not against the wall, you don't have to refinance or put yourself in a position that's pretty precarious when the market might not be that good. You know, would I pay retail price for something? Sure. If I got it at a 2% interest rate, seller financed on a 10-year term with a interest only or a 30-year amortization schedule, I would buy that deal. Why? Because I know that I can make it make sense and I know that the cash flow is going to be greater than my cost of capital. So buying it on terms is okay and to pay a retail price is okay if you have great terms. Otherwise, just focus on the purchase price. All right, the second thing, and you've heard this one before, is location, location, location. That being said, I've made some of my best returns and worst returns in war zones. So I got started in rough parts of town. I mean, literally shootings happening. Literally, if you take the boards off the door and you leave it unlocked, or not even unlocked, if you just leave it unboarded overnight, the door gets kicked in, all the copper plumbing gets ripped out, all the mechanicals get ripped out, you got to redo it all over again. I've been in those places. There's not stability in the tenant base. There's not stability in making sure the property doesn't get broken into. And so that creates a big cost in owning the property. There's a lot of turnover, there's a lot of expense because of the turnover. So I don't buy in D and F class locations. Then I kind of graduated to C class, and that was a little bit better, but there's still a lot of tenant turnover. And I think C class looks really good on paper usually, but it very rarely shakes out to a 94% occupancy over the course of a year. It usually drops down to that 80, 85% occupancy, and it's a struggle to keep tenants in. I graduated from C class into more of a B class and A class environment, and just solid workforce type housing. Again, it doesn't have to be luxury, just solid areas where people would desire and want to raise a family. All right, the third one kind of works into number one, but it's finding motivated sellers. Now, motivated sellers have historically been found really good deals, off-market type of deals. And I think off-market deals are a great way if you know how to source those off-market motivations. Typically, that breaks into the 4 Ds: death, disease, divorce, disaster. Right? Death, somebody passes away, probate court, the heirs inherit it. They don't care about, splitting the money 6 different ways on $1 million property. If they took a $200,000 haircut, it's really only like 20 grand per family member, and they just want to get it gone. So that's a great place in order to go out and source deals. I know people who go and find deals on probate all the time. Disease is another one. Unfortunately, people get sick, and that's not like necessarily having a disease, but like my parents looking to downgrade and downsize their home, right? It's harder for them to get up and down stairs now, so now they want something all on one level. Something along those lines are motivated factors for people that, like my parents, who aren't necessarily money motivated, right? They have the house paid off, they're in a good financial position, they just don't want the headache anymore, and they want to move into something that's more comfortable for themselves. Divorce, right? One of my early first deals was a couple that was selling a 4-bedroom house right here in Mount Pleasant, South Carolina. And by the way, Mount Pleasant's a town of like 130,000 people. There's not a single family house here today that sells for less than $500,000, $500,000, $600,000. One of the first deals that I did in Mount Pleasant back, 15 years ago, I guess, was a wholesale deal, and I bought it from a couple that couldn't finalize their divorce until they liquidated all their assets. So they had this single family house I put under contract for $100,000. But that's a big motivator, right? People, they don't care as much about money, they just want to be gone and done with each other. Death, disease, divorce, disaster. Another one's disaster, right? Like, I remember when that hurricane came through like Panama City, all these people got these huge insurance checks, and they got paid out big time from insurance. They didn't give a rat's ass about the property any longer, and they were just launching these properties at bottom, 20 cents on the dollar because they got the big insurance check. All those things are motivating factors that you could find off market. You know what else is a motivating factor? Somebody who picks up the phone, calls a real estate agent or a real estate broker, tells them that they want to sell their house. They have the real estate broker come out and meet them, take a bunch of pictures, they stage it, they make improvements to the property, put it on the market in order to tell everybody in town that they're motivated and they want to sell their house. I know some people don't like going on the MLS or on LoopNet in order to find deals. I find deals on there all the time. The difference is you gotta swing the bat, you gotta make an offer. And then the other thing is number 4, which is have a specific buying criteria. Whoop. So here's what I mean by that. Some people just say, oh, I do deals, right? I do deals all over the place. It's kind of like the new car you just bought, right? You didn't even know that car existed until you bought it. Now you see it all over the road because you're focused on it. Same exact thing happened for me when I stopped doing crappy deals, right? And I started only looking for apartments. And so I used to flip single family houses, somewhere between 80 to 120 houses a year. We did it on a turnkey basis. And I went on vacation one time and I realized, majority of my wealth, majority of what I liked doing was in the multifamily space. So in 2017, I drew a line. I said, we're no longer flipping houses. We're only buying apartment complexes. And guess what happened? We only started seeing apartment complexes. When we stopped wasting our time looking at single family, there were more and more and more commercial deals that came across our desk. If you're only focused on that type of asset class, you can sort faster, which is number 5. Have a sorting Mentality. People get so committed to a singular deal. They get so committed to trying to make this, they get emotionally attached to it, and that's a mistake. When you sort past deals, you get to the next deal faster than maybe your potential competition would. So the quicker you can run through deals, by the way, make an offer on everything. Make an offer on every single deal out there. I'll give you another example, is I just listed an apartment complex with creative financing terms, and I had over 500 people reach out to me on social media saying they were interested in seeing more information. I sent them all the information. Less than 15 people actually made offers. 3%. You think like, oh, I'm competing with 500 people. No, you're competing with 15 people. And if you come in with a creative offer and we hop on a phone and I feel good about you, which is what ended up happening, right? I narrowed it down to 2 people and ended up having a good conversation with 2 people. I was flexible on my terms. I was able to work through it. I was able to make a deal happen that worked for them and that worked for me because they were willing to swing the bat and just get the conversation started. Most people, the other 485 people, didn't even swing the bat. If you don't swing the bat, how are you ever going to hit a home run? How are you ever going to get a base hit, let alone a home run? You got to swing the bat. So have a sorting mentality, make the offer, and then quickly sort past that. If it doesn't work, don't get emotionally attached to it. It's all data, right? Don't be dramatic. It's all metrics. It's a math equation. Does it make sense? Does it not make sense? Move past it, move to the next one. Move past that one, go to the next one. The faster you sort, the quicker you're going to be able to find deals. So those are 5 rules of the road in order to go out and find deals regardless of the real estate market, regardless of the economy, regardless of interest rates. This is how you go and do deals in any real estate market.